Trading shouldn't be hard after this video because you will be able to identify proper setups, trade with high accuracy setups, and quickly redress losses into winning trades. So pay close attention and let's get it started. So when a market follows a downtrend, right, we know that means that it's forming swing lower highs and swing lower lows. So the simplest form of trading this market is to look for sells near the past swing highs, basically trying to predict that the market will not break above the last swing highs, and instead, it will break below the swing lows. And the level or area where smart traders here look for setups are supply zones. You probably know what they are. Especially my subscribers should know them well. So anyway, the point is that traders will sell the supply, and guess what? If they've done the analysis and everything properly, they might end up with a winning trade. And sometimes these supply zones are met in chain effect. Something like after closing with a take profit below the lows that they've just broken, the market forms a bearish break of structure. And after a break of structure, the most common move is a pullback to rebalance the liquidity. And a pullback on a downtrend is basically an upside movement. But the last impulse to the downside has probably also created another supply. So where will the market have a high probability of rejecting back down? Well, from the newly formed supply. And what traders are looking to do? Selling short the supply and taking profits when the market breaks down below the last swing lows. So this is the natural flow and intention of pretty advanced traders that are using simple yet effective concepts. But the market won't just go down forever, else there would be no buyers to close their position and no liquidity to allow for sellers to open their positions. So at some point, the sellers just lose strength to buyers, and the market eventually breaks above the last swing high. But keep in mind that sell-side traders and bearish traders have seen this downwards push and have taken it as a supply. But the market has just broken above the supply. So this actually stops the sellers out of their positions with a loss. And until now, everything is so simple that you can literally learn from just one of my videos on this channel. So if this is all you know and can do, it's still great. Because if you are able to win 2 to 3 trades with positive risk to reward, and then lose one trade, well, you still ended your trading session with profits. So more is not necessary if you are very good at identifying the point of interest and entry model that has a higher probability of respecting. But let's assume that you can't properly identify all of the highest quality setups, and being realistic, nor do I, and actually like 90% plus of smart traders are not able to get them right a lot of times in a row in the same trading session. Yes, it might happen today and tomorrow, but in the long term, it's actually really difficult. So what we do in that case, this is where the concept of flip zones come into play. Having the market breaking up above the last swing high in a downtrend forms the bullish market structure shift. So right at that point, where the market breaks above the last swing high, we look for a demand zone inside the low time frame internal trend, basically inside the pullback, and that demand is the flip zone, and we look for buys on the flip zone when the market pulls back down. And now here comes a question. What if this market structure shift was just a liquidity sweep and the market will also invalidate this flip zone? In that case, we'll get trapped and lose 2 trades in a row, the loss from the last supply and a loss from this flip zone. Well, this is the thing. We don't actually try to predict a high time frame reversal. We are assuming that this can be a trap, and we have a solution that is simply to not trade the high time frame trend, but to trade the internal trend on the low time frames. So basically, if we see this demand flip zone, we zoom into a lower time frame once the market hits the demand flip zone, and we wait for a bounce from the higher time frame flip zone to confirm that the market reacts to it. If it does, we look for another demand zone inside this lower time frame, and we take the market higher with a buying position. Now, in case where the market follows an uptrend, we have the swing higher high and higher low formations on the high time frame trend. The intentions of smart traders is to look for buying opportunities near the swing lows, basically buying the pullbacks and selling into the new highs. And we do that 1 time, 2 times, 3 times. This is a pretty common strategy, and it's popular because it's both simple and effective. The low time frame internal trend being bearish, but the high time frame external trend being bullish. So traders will look for the moment where the internal shift happens, and the low time frame trend on the pullback aligns with the higher time frame external trend, both moving to the upside to break into new highs, but eventually the buyers can't push the market higher, and sellers see that and enter the market. this increasing selling pressure and taking the market down. So far, nothing new, as this is just a low time frame pullback. But if the price continues this internal downtrend and breaks down below the high time frame demand, then this forms a market structure shift on the overall external trend. Right when the shift happens, we know that after any important swing break, the market is expected to form some kind of pullback. And a pullback on a market that just reversed bearish is a low time frame internal uptrend. So right after the high time frame structure shift, we look for a high time frame supply. But again, we need to assume that this can also be a trap. So in other words, this structure shift can be a liquidity sweep, and the market could just as well break this supply. But that is why, when the market hits the supply, we move into a lower time frame. And if the price has shown a bearish reaction from the high time frame supply, we look for another supply, but in this lower time frame. And we look to sell with a 1 to 3 risk to reward, or it can be slightly higher, but wouldn't go above 1 to 4. So let's actually see how that would work on the charts. We are going to test two of the most popular markets, the first one on the FX markets, and more specifically on the euro against the US dollar, 3rd of April on the 1-hour chart. From the first view, we see a macro downtrend, but let's analyze each swing move closely. Here at the start, we've got a descending move, which is then followed by an upside pullback. As usually, the pullback should end on a supply since this is a downtrending market. And the setup planning for this kind of trade is pretty simple, and you probably already know: sell short on the supply, stop loss above the supply, take profit at around 1 to 3 risk reward. And basically, the market moves into the supply, rejects from the supply straight to the downside, eventually forming a new lower low, which is a bearish break of structure. So a simple and straightforward planning. Then after a break of structure, as I said before, usually a pullback is seen, and a pullback in a high time frame downtrend is a low time frame uptrend. Pullback that also ends up filling a new supply and rejecting back down from the supply with basically the same setup planning as before. This is what we've said before as being a chain of supply zones. Then after the new break of structure, again a pullback that ends on a supply, and then we sell short into new lows. A chain of 3 supply zones, one after another. Currently, it's moved close to the take profit, so we need to see the upcoming price action. Since we are in a downtrend, we want to look for trend continuation. And that would be the case if the market breaks down below the last swing lows, so essentially continuously forming bearish breaks of structures. So far, we're consolidating below the lows, and looks like this won't move well for sellers. The market pushing up pretty aggressively with many bullish candles. It's almost closing this position with a loss, approaching the stop loss. It's also right on the supply, and there isn't any bearish reactionary movement so far from the supply. So it makes having a very high probability that this supply will actually break this time. So we've had the pullback to the upside from here, which formed the lower high. But then it has failed to form a lower low, and it has actually formed a higher low on the bottom from where the market has started this very bullish price action. Price action that broke above this high, and looks like it's soon also going to break this high as well. So the first break of the highs is the market structure shift towards the bullish side. And if the supply has a high chance of breaking and losing the trade, we look to flip the view and trade towards the bullish trend. We can do that by identifying a demand flip zone. So basically looking for the last demand on the downside, but this demand is still not validated. It will be only if the price breaks the supply to the upside. And if it doesn't break, we just keep the sell short position that is already there. So we wait and see what happens. Couple candles later, it hits the loss, so that means that it has broken the supply. Now the flip demand zone has validated, and what we want to do now is to switch into a lower time frame and wait for the price to pull back into the flip zone. So this is the 5-minute chart. We're zooming out a bit. This is the flip zone on the downside, and the price is sitting right now at the break of the supply. So we wait to see what the price does. Eventually, it has to come back into the flip zone to rebalance the liquidity. So we just have patience. Usually I place an alarm when the price is moving close to the point of interest. Or you can also analyze the internal price action in the meantime, and you could also look for quick scalping setups in between these zones. But for that, we need to analyze the internal price action. So here, we've an uptrend formation that has eventually broken up the supply, and then it is pulled back to the upside, but has failed to form a higher high, and instead it has formed a lower high. Then it started a low time frame bearish movement to the downside, move that breaks the internal swing lows. So that forms an internal bearish market structure shift. The shift confirms and validates an internal downtrend. And on a downtrend, we look for supply zones. We can see, for example, from the move that we can already see here, that the pullback has ended right on a supply. So the setup planning here is interesting, because some might also look to take profit on the top of the flip zone, since that is our desired higher time frame point of interest. But no matter the market structure, the risk to reward is just way too high. Almost 1 to 9, so I wouldn't take with that planning. But we can see that from this rejection on the supply, we actually formed another supply. So we'll look for the setup planning on this one. Some might look to target the flip zone as well, but that is too dangerous and risky. I would take half of the risk-reward ratio instead. And this actually worked out very well. It has filled the supply with a wick, and on the same candle it rejected back down, actually moving into the flip zone. This kind of setup is not met often. Now, after rejecting the supply to the downside and closing on the take profit, the market is pulled back to the upside. And just like before, where does the pullback usually end? It ends on a supply zone, so another opportunity to sell short right here. So now that the market is at the flip zone, we want to see how it reacts. And in this case, it looks like it has validated the flip, because it has formed a bullish reactionary move soon after hitting it. So now, we can consider to look for another demand for the trade itself, because the higher time frame flip zone is just to confirm that the market reacts to it, and now that it does, we can look for the entry itself. The entry is simple, just looking for the most recent flip demand, which would be this one, and now we manage the setup planning. Stop loss below the newly formed flip zone. Take profit at 1 to 3 risk to reward. We can also look to target the swing highs on the external high time frame, but that increases the risk of hitting the stop loss. I wouldn't do it. Maybe only on some rare occasions. Here the flip demand and position got filled. And this looks to take a while, but the pressure still looks to be more on the upside, especially that we've got breaks of internal highs right here, then the other highs as well. And we would also look for the next ones from above, which are close to the take profit area. Larger bullish candles form again, and you can also analyze this internal price action. Without trading it, we're basically just waiting for the position to close either with a win or a loss. But by analyzing the price action, we can get a view of where the market is more likely headed towards. So for example here, the price filled this small demand, then rejected right back to the upside, so it shows that demands are still under control. So buying pressure to continue higher is still on the books, which eventually did a couple minutes later, finally closing with a winning position. Now on S&P, in the 15-minute time frame, we see this volatile price action with a higher high, then a pullback that comes back down and rejects from a demand zone. This rejection actually pushes the market to the upside very aggressively, with large bullish candles, eventually breaking up above the last swing high. So if we break above swing highs in an uptrend, we have a bullish break of structure, basically just a continuation of the uptrend. And after a break of structure, we expect a pullback to rebalance the liquidity and feed the next large move. It's what usually happens, as you've also seen on the last chart. Then eventually, the last internal lower high breaks and forms an internal higher high. So that's an internal market structure shift towards the bullish side. That just means that the low time frame internal trend is aligning with the high time frame trend, both moving to the upside to continue the uptrend, and we also have an internal demand zone formed from the upwards impulse that created the low time frame shift from a downtrend into an uptrend. So it's just aligned both the external and internal price action to the same direction, that is, to the upside. But this demand looks like it did not fill, and the trend continued to the upside, breaking above internal highs. So again, we have a bullish break of structure, and a break of structure validates a demand zone near its lows. So we test the setup once again, just as usual. Stop loss below the demand. Take profit above the highs, but just to have around a 1 to 3 risk reward. And it has actually broken to the highs before filling the demand. So we invalidate the last demand, and since we have a break of structure and also a new demand right here, we look to take the new demand. The price is actually sitting right on its zone currently. So the same setup positioning, 1 to 3 risk to reward. Position got filled. Nice bullish reaction. And this was a nice and quick win. We should also look at how the market has moved, the structure itself. For example, after this impulse upwards internal move, the price started forming lower highs and lower lows exactly on the demand zone. Then it breaks above the last internal lower high, which is an internal market structure shift, a shift that aligns the low time frame downtrend into a low time frame uptrend, together with the high time frame uptrend, eventually having formed a local high, from where a small downside pullback happens again, but shortly lived because the market breaks above the highs quickly. So again, a break of highs on the internal structure is a bullish break of structure, but internally. So a break of structure validates a demand. This one already got filled right here, but it actually ended up with a loss, breaking down below the demand. And that means that it has also broken down below the last lows, having created a market structure shift, but this time towards the bearish side. So if it has invalidated the demand, we now look for the supply flip zone, which could be this one right here, but could also be this one from below. I'd usually go for the most recent one that is responsible for the last break of structure, because the one from above failed to fill on the pullback, and it has pushed the price even lower from there. So we try this one if the one from above did not fill. Stop loss above the supply. Take profit at around 1 to 3. Now here we can apply a trick. The market might still be bullish on the very high time frame, and we have unfilled demand zones from before. So we can also take into consideration that the market has an increased probability of moving towards the high time frame demands to attract more liquidity. So if we consider that one of those demands will fill and respect, then we can take profit on the top of one of those demands. The first one would decrease the risk-reward ratio, but it will probably be a good idea since we can't know if those demands will actually respect, leading to a losing trade. This might be a good decision after all. At least the trade closed with a win, and now the price is resting right on the very high time frame demand. And it broke down below this demand, and below the one from the bottom as well. So the ones that have chosen to close that selling position lower had won more out of that position since any upside momentum has been invalidated currently. So we check what the price has done. It has basically just continued lower with some insignificant upward pullbacks that quickly got faded down. So far, the expectations are towards bearish continuation, so let's see. The market continuing this momentum, nothing new so far. But we can see a small supply zone right here. Now this failed to fill. And then we have another one around this level that is yet to get filled. So let's actually try and see, as you probably already know how to plan the setup. And this closed on a loss hitting the stop loss. It's not a big problem. Especially because if we carefully watch the price movements, the market now actually broke up above the last high. So yes, it has broken up the supply, but more importantly, we have formed a bullish market structure shift. So now we do look for a demand flip zone. To identify that demand, we look for the most recent downside that caused an upside impulse. Now, this could be here, but this is just the internal price action that looks like it wants to move lower from here. So the one from below is near this price level. Let's try this flip zone. Buy position on the demand flip. Stop loss below the flip zone, and around 1 to 3 risk-reward ratio. And this flip zone breaks down with a loss. We have one more potential flip demand on the swing lows, which is exactly where the price is right now. So to make sure we have correlations with demand, there is actually another demand that has filled from this price level before. This kind of increases the probability that our flip zone will hold this time. Now to increase the probability even more, we can switch into a lower time frame and see how does the price react from this zone. If it has a bullish reaction, it will probably respect. And if it doesn't print a bullish reactionary move, then it has a higher risk of breaking down. So this is inside the 5-minute time frame. Here it's interesting because traders that are not aware of the higher time frame trend would probably look for supply zones near the swing highs. They are basically looking to sell short, being unaware that there is a demand flip zone on the bottom on the higher time frames. and the higher time frame has priority over the lower time frame, and eventually breaks down one of their supplies, taking their stop losses. And more important for us is that the market has printed that bullish reaction that we wanted, so we have confirmed that this flip zone will likely respect. And now we look for another demand flip zone inside this low time frame, and it's quite easy to identify it, being the last downside candle before the upside impulse. Should be around this level. Now we position the setup, buy long on the demand, stop loss below the demand, and here we can also target the upper side of the low time frame supply. This way, we are essentially trading against the seller's view of this market. But as I said before, the higher time frame trend has priority over the lower time frame one. So there might be a higher likelihood that this demand will respect. And if it does, that means that the low time frame supply should not respect. That means that it probably will break this supply, and it's where we can position the take profit towards. This makes it quite a high risk-reward ratio setup, but it has more confirmations than just a simple random setup with the same ratio. But also if it does break, that would form a market structure shift internally. This shifts the low time frame downtrend into a low time frame uptrend, so it probably has more liquidity and swing levels to break. We can zoom out and see if they're far away. And fortunately, they're pretty close to our initial target. So we can actually target these higher levels. If we see that it bounces up, and the moves don't look like it has enough buying pressure, then we will probably manage the setup and lower the profit target. Position got filled now, and soon after one large bullish candle reacts, eventually forming even more large bullish candles. This is the important level. It's sitting right on the supply now, but has instantly broke it to the upside. This is why I focus a lot on saying that time frame priority matters a lot, closing with a beautiful winning position. And having actually validated the internal market structure shift, now this low time frame downtrend has more than likely reversed into a low time frame uptrend. But more on that on another day. For now, it's more than enough. And updates are coming into my trading program that you can see on the link in the description, so stay tuned, especially the current members, because once you've joined, you receive all lifetime updates for free. Thank you for watching.